Welcome to Investor's Guide and thank you so much for tuning in. This is a show that will help you find the perfect investment portfolio that suits you best. Now we know the stock market is at an all-time high. The Nifty crossed 8,000. On this show, we'll help you make sense of all of that and we'll find out how you can make the most of where the market is through your investments. Remember, our email ID is at the bottom of your screen. You can send in any question you have about your money. You can also reach me personally on Twitter. Let's get straight to it. On this show, we'll help a young investor buy his first home. In our product review, we look at the Birla Sun Life Frontline Equity Plan and we'll tell you where to invest to create long-term wealth. It's time for me to bring in Narendra Kumar, the CEO of Value Research. Narendra, thank you so much for joining us.
Thank you.
Of course, like we've been watching the market lately, 8,000 on the Nifty. It's at an all-time high. And as always, there are analysts who are jumping over each other trying to give us the next prediction. Some are saying 9,000 before the next budget. Some said 10 even. Now, I'm not going to ask you where you think this market is going to go over the next 1 year because for long-term investors, that's rather irrelevant. Tell me this, if I'm an investor who has not invested in stocks or mutual funds up till now, can I start now?
It's far easy to make mistakes now than you could have, a year back or, year and a half back. In a depressed market, you can't really go as wrong with your long-term investment. Investment mistakes are generally done in a market when market is continuously or relentlessly going up. I think it's time to be, if you have a plan, stick to it. If you don't have a plan, don't jump in. And, if you follow, what we have been saying over the last 2-3 years continuously, even at the cost of, sounding repetitive, I think one should stick to that. Invest your long-term money only into equity. Don't put your short-term money into equity. At this level, markets can become very volatile or it can go down in value for a brief period and you will not have the patience to stick to it. So make sure that you have that allocation. The money which you are unlikely to need for many years should only be earmarked.
Well, Narendra, a lot of viewers are now writing and asking us if they should be investing in mid-cap funds or small-cap funds, which is understandable given the performance of these funds. But we've always told them to stay in equity diversified funds. What is the risk right now of picking up a small-cap fund as a first-time investor?
Investors today will be looking at just one side of it. One should just recall, one should just have the perspective that how these funds were struggling in 2011 or 2008. In fact, many of these funds went down in value by 70-75% or sometimes, even 80%. So imagine, if you invest a sizable amount with huge expectation and that goes down in value by 80%. I don't visualize that, there will be such correction or, 2008 kind of thing will be repeated. It was certainly an extraordinary situation. But at the same time, I don't think it is worthwhile just looking at return and not taking a note of the underlying risk. And small caps are more volatile.
Then the last very quick question. Obviously, when the market right now at 8,000 seems a little overvalued, there are analysts who believe that we might see a bit of a correction going forward. Now, do you believe that investors should wait for that point, wait for a small cut in the market before they get in? Or do you think that if we are long-term investors, again, it's completely irrelevant?
Yes, it's completely irrelevant and it doesn't matter because if you are investing for next 5 years, next 10 years, trying to catch the low point of the market is meaningless. The biggest moves happen in market when you least expect it. And so trying to time it perfectly, and none of the fund managers have been able to do it well. There is a problem of a one-time investment, trying to time it. If you succeed, then there's a great possibility that you will walk out of the market on attaining a certain gain or appreciation, and maybe wait for the market to correct again. Being wrong, the risk of reinvestment you will be faced with, and you might be left out.
All right, so here are the basic ground rules, and the ground rules on this show never change. Invest regularly. Don't attempt to time the market. Use diversified funds that spread your money across the market as much as possible. Don't get carried away by recent performance. And of course, write to us if you have any questions. In fact, let's take one of those questions that came in from a young man. This is our portfolio segment. Anil has written in, Narendra writes in from Hyderabad. He tells us he's 25 years old with a take-home salary of 42,000 rupees. He's already bought a term cover of 1 crore rupees. His family has a health cover of 3 lakh that comes in from his employer. That causes some concern for me, but we can come to that later. He invests 2,000 rupees every month in his PPF account, and 28 1,000 rupees in his mutual funds. He has a goal to buy a home in the next 1 year. And he has various questions, Narendra, and he sent us a list of the funds that he's investing in as well. From my mind, first of all, I would like him to increase his health insurance cover for his family because he's relying on his employer. But when you look at his funds right now, he has 4 tax-saving funds and he has 6 equity diversified funds. They're great funds. Does he have one too many, perhaps?
No, the way I look at his portfolio is that he has actually, chosen good funds, so he's not at a loss. But his sense of, diversification is to invest across various kind of fund with, a small and mid-cap fund, or he's looking at balanced fund differently. I would say that, he can do with fewer, though he's not at a disadvantage. For example, I don't see a rationale for him to have this balanced fund, given that he has his fixed deposit, he will have his EPF contribution and 2,000 going into PPF. And he is going to be a long-term investor. His portfolio needs simplification. And I would say that he can do with just 1 or 2 ELSs, maybe just 1. And he should look at his tax-saving fund as his equity allocation.
All right, Narendra, from the 4 funds, and this is one of the questions he asked us, he has Access Long-Term Equity, Franklin India Tax Shield, Quantum Tax Saving and Reliance Invesco Tax. Those are 4 funds. You've told him to retain 2 out of those. Now, assuming he waits until his lock-in is up and he removes the money from 2 out of 4 of those funds, which ones would you like him to hold on to?
All the 4 funds are good funds, so it's not an easy task choosing 2 of the 4. But if I have to, I'll choose Access and the Quantum Long-Term, the tax-saving fund.
All right, he has one more question for you, Narendra. He wants to save some money for a down payment on his home. He needs 6 lakh rupees in the next 1 year. He wants to know if a short-term debt fund will give him better returns over a fixed deposit. And given what you know about his portfolio already, where would you like him to invest that down payment?
Yes, short-term debt fund will be a better option. Of course, the tax advantage is gone, and it is likely, and in 1 year, for a 1-year investment, it is unlikely to yield him anything more. Any advantage in terms of tax, but his money will be more liquid and he will be able to earn more return than a 1-year fixed deposit will yield him. That apart, there is an offbeat chance that a rate cut and the return from the short-term debt fund can get enhanced.
All right, so there you have it. That's the advice you're getting right now. Remember, you can get back in touch with us if you have any more questions or if you'd like us to take a look at your portfolio. Write to us. Email ID is at the bottom of your screen. Let's take a look at our hold or sell segment. Abhay Patil has written in, he's 41 years old, Narendra. He's been investing 80,000 rupees in mutual funds every month to create long-term wealth for his retirement. He wants to know if his portfolio is on track. Now, he hasn't told us what this investment is for or what his time horizon is. And since he's about 40 years old, we'll assume that he has 20 years to go and this is retirement money. Right on top, the Birla Sun Life Frontline Equity and the Franklin India Blue Chip Fund, Narendra. Someone in his age group, should he hold on to both of them?
Yes, both funds are good. And I would say that Blue Chip is not necessarily that diversified, but still, given its track record and a really committed Blue Chip portfolio, I would say that he should carry on with both.
Carry on with both of those funds. HDFC Equity is the next on his list, Narendra. I know you're going to say yes. For all of our other viewers in the same position as Abhay right now, HDFC Equity is a must-have?
Yes, HDFC Equity is a must-have, and it's very important to recall what happened to HDFC Equity. Investors were getting anxious about a year back, and so once he's investing, and the kind of fund he has chosen, it'll have its ups and downs. He should not look at relative performance very closely on a 3-month or 6-month basis. And yes, this is a good fund to have, and it has a long history to bank on.
Well, the next on his list is the ICICI Prudential Dynamic and IDFC Premier Equity. Narendra, when I look at his list, I obviously know that he's someone who's been tracking our advice very carefully. He's following everything we tell him on the show. Would you recommend he holds on to both of those funds?
No, I would not like to take the credit from him. Maybe he is a great fund selector. He's able to choose good funds on his own. But yes, his selection matches with ours. And both these funds, once again, I really have no doubt that so far, these 5 funds combined together make an excellent portfolio, and none of these funds are worth, stopping his investment or discontinuing his investment or moving his money elsewhere.
All right, next two on his list, SBI Emerging Businesses and UTI Opportunities. Narendra, SBI's Emerging Business, would you like him to continue that one as well? It's been such a stellar performer.
If somebody has, 2 or 3 funds, then maybe Magnum Emerging Business may not be part of it. But given his, a portfolio so well spread, that if this happens to be 1/8 of his investment, 12.5%, then I think it's a very desirable addition.
All right, last fund on his list is the ICICI Prudential US Blue Chip Equity Fund. Narendra, what would you recommend he does? Continue to invest in it?
Yes, that's a fund worth investing and continuing his investment, because there are 2-3 ways of investing in US equities. Yes, it is low on technology, and that has been that has been driving the performance, or that brings in some degree of outperformance compared to the general market. But this is a fairly stodgy portfolio, and it's a meaningful addition. Maybe, if it's 1/8 of the portfolio, if he's investing equal amount in each of these funds, I think it's also a meaningful allocation.
It seems like your portfolio has 2 thumbs up there from Narendra Kumar. So don't make any changes and reach out to us if you have any more questions. Let's take another question. Mahesh has written in. He's invested in HDFC Top 200 and IDFC Premier Equity in July 2010, Narendra, which means that he has made good returns. He said the aim was to generate a return of 15% over 10 years. He wants to know, will this investment give him the desired returns, or should he make any changes? Good funds, Narendra. Can he hang on to them?
Absolutely, and I think it's very one that his expectation is not unreasonable. There has been time in the last 3-4 years when he might be, if you would have looked at the value, he might be disappointed, but not now, in my opinion. At the same time, I think next six years, everyone has every reason to be very optimistic, and 6 years time frame, and given the quality, the orientation of these 2 funds, I don't think you have much to worry about. And also this, 15% return compared to, 8.5-9%, which you are able to derive from fixed income. It's not a substantial premium that investor is expecting from equity for assuming the risk.
All right, so your expectations are completely reasonable, and of course you should hold on to both of those funds. Then a very quick question: if you look at those 2 funds, and he only has those 2, do they complement each other well? Does he need to add a 3rd fund to his portfolio at all?
Any addition to this portfolio may not be very meaningful, or this makes a complete portfolio. One, these 2 portfolios are unusually different. I don't think they have complementary positions. There might be some. Both fund managers have long track record. They think differently, and they have credible history. So I don't think you need to really add anything. Be watchful. If you see consistent underperformance for a period, maybe 1 or 2 or 3 years, that's the time when you should be taking a call, but not before that.
All right, so that's Narendra's advice to you. Let's move on now to our fund review. This week we're looking at the Birla Sun Life Frontline Equity Fund. Avan is here to give us an introduction. Avan.
Thanks, Faye. Launched in August 2002, the Birla Sun Life Equity Fund is something of an index fund. It aims to replicate the BSE 200 by using the same sector weights as the index, but using a different stock selection within those sectors. This strategy is a way of ensuring that sector-wide events and trends do not affect the performance of the fund, while the stock selection brings in the returns. Has it worked? Well, the fund hasn't underperformed the benchmark for over 10 years now. Right through its history, this fund has managed to rise more than the benchmark in good years and fall less during bad times. The fund has given an average return of 22% annualized over the last 10 years, ranking among the top 5 funds in its category over the last 10 years. Let's do the math to give you a better perspective. If you invested 1,000 rupees in this fund, you would have 14,351 rupees today. So despite the proven track record and very little reason to doubt its good returns, should you be invested in this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. Narendra, one of the oldest, strongest funds that we have in in the industry right now. Last time we talked about this fund, you gave it 4 stars. On value research, it continues to have 4 stars. I just want you to give us a review of its recovery process. While the market turned around this year, how would you review this fund's ability to turn around with the market and stay on top of those returns?
No, I think this fund has done a very remarkable job. One, it was among the best performing fund. 2018 was an extraordinary year relative to other funds in the category. And I think that is the strength of this fund. This fund tries to, its benchmark is BSE 200, and it never, it has to follow the sectoral, weightages. So from that standpoint, it always remains diversified. It never gets tilted to a specific sector. That part, I think, it's and its strategy is pretty simple. It is indexed with a garnish. It can be very selective. It can be selective with its position in various stocks within the index, and it can completely keep away from certain stocks to represent an index. And 2013, I think this fund's selectivity proved that translated into handsome return. This year, and that diversification or that conservatism in its selectivity has been a little drag, but it is not a gross underperformer. I would say that it remains a fairly well diversified fund. Recent times it has done exceedingly well, and relative to other funds which are able to deliver superior return by taking some unusual bets, and that also translates into greater volatility or going down in value over a brief period of time substantially than this fund, they might look better. But if you are looking for consistent performance from a diversified fund, I think this looks like a very good choice.
And Narendra, finally, what's your star rating of the Birla Sun Life Frontline Equity Plan?
I would give it a not a 4-star but a 5-star this time, and also it has been part of our portfolio, and we were not tempted to substitute it with any other position in a few of our portfolios.
All right, 5 stars there for the Birla Sun Life Frontline Equity. It's been upgraded by 1 star, and 5 stars is very hard to come by on this show. So if you have any questions about that fund, write to us. Quickly slip in another question. John has written in, he's an NRI who can put aside 30,000 rupees every month in mutual funds. His aim is to accumulate a corpus of 15 to 16 crore rupees in the next 25 years. He says he's put aside everything else, Narendra, the emergency fund, the life insurance, all of that has been set aside. He wants to take some risk with this investment. It's for the long term. What would you recommend he does? Should he pick up our growth portfolio?
For his goals, I think he should choose our aggressive growth portfolio. And going by what is going on in the market, what has happened in the market, our aggressive portfolio is not that aggressive. So if he has his employee provident fund contribution going, or if he's somewhere putting he has a term deposit, he can do with our he should replicate our aggressive growth portfolio without the fixed income allocation.
All right, our aggressive growth portfolio is on your screen right now. We're going to take a very quick break, but before we go into break, Narendra, thank you so much for joining us this week and answering all of our questions.
Thank you.
We look forward to sitting down with you again next week. Coming up after the break, we'll tell you where you should be investing your long-term money with Vishal Kapoor. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. We brought in Vishal Kapoor to answer your questions this week. Vishal, thank you for joining us. Our first question comes in from Vijay, who writes in saying he has a term cover of 50 lakh rupees and a family floater health plan of 15 lakhs. He now wants to begin investing 5,000 to 6,000 rupees every month with a time horizon of 20 years. Where should he invest this money? Vishal, it's so great that he wrote in saying all of his insurance needs are taken care of. What would you like him to do with the rest of that money?
For Vijay, assuming that again we've done his risk profile and he understands the risks in some of these funds, I would think that a balance fund may be a good way to start, and the ICICI Pru Balance or the Tata Balance funds might be the two that he could start with. Now, provided Vijay is okay with slightly higher proportion in equity from what a balance fund will give him, and a diversified equity fund may also be a very good choice. In that, again, he could look at either the ICICI Pru Top 100, or he could look at the Birla Frontline Equity or the UTI opportunities or a growth portfolio that we have in Investors Guide as ways to achieve this end.
Swati has written in, she's 44 years old. She wants to set aside 1 lakh rupees every year for the next 8 years for her retirement and for her daughter. She wants to know where she should invest this money. Vishal, she has 8 years, which isn't a very long time. How would you like her to split up the equity and debt asset allocation for this investment?
For Swati, let's assume that this is an investment portfolio for her daughter. Therefore, it's for the long term, at least for 8 years. And two is, let's assume that she will understand and fully appreciate the risk that some of these proposed investments have in them. We would actually propose an aggressive portfolio or a growth-oriented portfolio which will have a higher proportion of equity in it to get started with, And then over time, as she's nearing her goal, which is either retirement, or if it's for her daughter, then the objective being either education or marriage, then closer to retirement or that objective, we would taper down the allocation into more fixed income. So for her goal, I think we will have to apply an allocation which could be reviewed every year and see that over time it is getting reduced from equity heavy to fixed income heavy till she reaches her goal.
Vaibhav Sharma has written in, he's going to become working really soon and he wants to put aside some money. He'll have a monthly income of between 18 and 20,000 rupees. Now he tells us he's joining a one-year program, so it's likely that he might not have a steady job after that 1 year is up. He wants to know how he should be investing, Vishal. So first of all, in case he's not able to contribute to this investment next year, it should be okay, and he'll need some money if he isn't able to find a job after his program is up. What would you recommend he does?
For Vaibhav, we are assuming that he will need the money after 1 year because he fears that he may be unemployed after that period, and therefore the saving objective in some senses is to build reasonable returns on his corpus so that he can sustain himself after the 1 year for whatever objective that he's saving for. And to that extent, I would suggest that he sticks with a short-term income fund for the time being. Now, if our assumptions are wrong and he is really looking at building a corpus for the long term, then he could look at long-term equity funds, in which case the diversified list of funds that we have as part of our growth portfolio may be a good way to start. So those are really the two alternatives we could look at. Given what we know, I would think that short-term funds with a 1 year saving objective may be more appropriate at this time because he's starting afresh, and it's important that he begins to understand how some of these financial products work, inculcating a savings habit and keep it liquid and keep it close and not have too much volatility. And then after the 1 year, if he's hopefully continuing in his job and beginning to save and save more, then maybe he can look at increasing his risk appetite and then taking more exposure to equity.
Noel James has written in, last question on the show. He tells us he has a home right now with an outstanding loan of 15 lakh rupees on it, but he now wants to buy another property that will cost him between 80 to 90 lakh rupees. Now, in order to do so, he wants to surrender 3 of his insurance policies to buy that home because he's looking at it not just as a home for his family to live in, but also as some sort of protection for him and his family when he retires. He's looking at it as an investment, Vishal. His question is this: if he surrenders all of his insurance policies, should he buy a term cover? Because obviously budgets are going to be tight. He has 2 home loans to pay off and he's the only earning member. So obviously he should buy term insurance. Vishal, which one would you like him to buy?
For Noel, there are a couple of approaches he could take. The first one is that to cover his own life and for the eventuality that something adverse happens to him, he should have a term cover. Now, to get the term cover, he could either go for a level term cover where he ends up paying a premium every year or periodically, or he could go with what is called an MRTA cover, which is a mortgage reducing term assurance cover, where he's getting the same cover, but that is built into the loan itself. So he's paying the premium through the EMI. It's a single premium plan typically, and the amount of cover goes down with the extent of loan. So as he gets his loan drawn down, his cover is actually coming off with the extent of the loan. So those are 2 ways. I would prefer the level term assurance cover because it guarantees him that amount of cover for his family should something adverse happen to him. The second area he should look at is health assurance or health cover. That's again one critical area and a must-do for him and his family. And the third area he should consider is that since he is now putting a considerable amount of his savings into a house, then some sort of property cover, both for the structure as well as the contents. So these, I would think, are the 3 basic insurance covers that Noel should look at for his family.
All right, that's a wrap on the show. Now, remember, we're not getting enough questions from our women viewers. If you're an investor, write into us. Our email ID is on your screen. We'll guarantee to take that question on the show. You'll find a copy of the show on our Facebook page, and you can reach me personally on Twitter. Thanks so much for watching.